In this week's Stockscores Market Minutes, we'll talk about using stops and whether you should use them, and if so, how to use them. Plus, I will do my regular weekly market analysis. We'll look at whether the markets are done their little corrective phase that we've been in through the month of November and into December. And then I will look at my day trade of the week on SGMA. All right, so should you use stop loss orders? Well, there's a couple things that we need to sort of understand first of all. The first thing, of course, is what is a stop loss order? It's an automated order that if price falls down to, your trading position will automatically be exited. So if you buy a stock at $11 and you put a stop loss in at $10, if the stock falls to $10, the automated system at the brokerage will sell your stock, and so you lose $1 a share. It's a way to limit the size of your losses, and that is a good idea because it's essential to not take big losses. In trading, it's the big losses that hurt our performance. However, I can show from my studies of data that using stop losses can dramatically affect, to the negative, your overall performance. And the problem comes with where people put the stops. If they put them too tight, they dramatically lower the probability of success on their trades. They may reduce the size of the losses when they do lose, but because they lower the probability of success, their overall profitability can be a lot less. I've studied my day trader strategy that I use every day, and a tight stop cuts the performance of the strategy in half. And so what I find is that the best thing to do is to put stops at the right place. Using percentage stops is a real rookie mistake. I see a lot of people say, oh, use a 10% stop or a 5% stop. Well, that's silly because every stock has a different amount of volatility. The price movement in a stock like Microsoft is very different than how a biotech stock might move. And so if you use the same percentage on a large cap, low volatility stock as you would on a very volatile biotech or small cap stock, you're going to get very different results. And so what's important is to use the last inflection point low. And so I'll show you on a chart of Ford. Ford was a hot stock on Friday. If we take this as our buy signal when the stock broke out from a pennant pattern on Friday. Now, if you use a simple percentage stop, you might have set your percentage there and you get stopped out. But the right thing to do is to look toward the last inflection point low. So that's the price point where price stopped going down and started going up. It's right here on this chart, $20.20. I'd put my stop at 2019. Perhaps 2018, just below that barrier. Because an inflection point means something. It's where price stopped going down, the sellers lost control, and the buyers took control and sent the stock higher from there. And so it's that line in the sand that the buyers and sellers have drawn, which establishes where support should be. And so if you put support at the right place, below that inflection point, before your entry signal, you're going to get a much better result and your overall profitability will be better as well. All right, let's take a look at our normal analysis of the markets. And of course, we've had some fairly strong selling pressure through November and into December, but that ended this week when the downward trend line was finally broken. So you can see there the downward trend line broken on Tuesday, I guess. And the result is that we've had a nice comeback rally, but we are still just sitting below the lows on the S&P 500. And so the upside is relatively minimal in the short term because of that resistance on the large cap stocks. Small cap stocks, or we'll get to the small cap in a moment. Here's the large cap 3-year weekly index, and then you can see the upward trend line. We bounced off of it, we bounced off of it, and the upward trend is still intact. We talked about that last week, and therefore I still remain bullish long term. On the NASDAQ 100, this is the daily chart. You can see there the upward trend line. We never threatened that. We had that pullback, but we never broke that critical upward trend line. We broke the little pullback line early this week, and we are building now a rising bottom. I think the NASDAQ probably going to move back toward the highs that we saw earlier in November. Now to the small caps, which I like to watch the most because for trading those speculative stocks, the ones that can make the big moves, the IWM, the small cap index, Russell 2000, is more applicable. And so here we can see that the Russell also broke its pullback, but it broke what we call a parabolic downward trend line. It did that early this week on Tuesday. But the linear downward trend line is still intact. So the market has managed to make a little comeback, but it hasn't gathered the upward momentum yet. What we want to see is a build of the rising bottom. If we can build the rising bottom and then break that little downward trend line, then the small caps and really speculative trading can move back toward the highs. And that's what I'm going to be watching for. So the chart is better, but it's still not out of the woods. Canadian markets, you can see also broke their little pullback line. If we draw a line like this across those tops, sort of ignoring that little blip, we broke the downward trend line. It's very common after the break of a trend line to second guess it. And so that's what we're getting right now. But as long as we can hold that cycle of rising bottoms, which we have so far, then we should resume the upward trend and move back toward the highs on the TSX. On the 3-year weekly chart, we are still in the upward trend, so the buyers are in control. On the TSX Venture, much like the Russell 2000, it's in that more substantial pullback mode. It's broken the parabolic move to the downside. That's a good step, but it still has to break the linear downward trend. Work to be done, something to watch for. On to currencies, US dollar continues to be in a bullish trend. This is the 3-year weekly chart, and the buyers are in control of the US dollar. Can't say the same thing for Bitcoin. It's been in 4 or 5 weeks of selling pressure after it hit resistance and got stuck. Normal, but the key thing now is, does the cycle of rising bottoms hold? If we were to break down through this low point, we would break that cycle of rising bottoms, and that would be a negative. I think Bitcoin's a bit oversold. It should bounce back soon, but it hasn't shown us any signs that it will. Ethereum also had a down week last week. It has now broken its upward trend line. That's a negative, but on a positive note, it still has potential for rising bottoms. And so the buyers are still in control, but it's definitely a little bit more of a seller's market in the last month. On to commodities, gold, pretty quiet, pretty sleepy. Tried to break the downward trend line, is pulling back and really doesn't look all that great, but not all that bad either. On oil, we talked about the upward trend line. I drew that last week. We were right at it, and we've bounced off of the upward trend line. We should move back toward the highs, but if instead we roll over and break down through that upward trend line, then get defensive with energy stocks. And finally, the fear chart. You can see that fear has fallen. We had that scare. We gave it back. We're almost back to the lows on fear. Still a little bit of fear in the market. I wouldn't ignore it, but not as bad as it was 2 weeks ago. So my ratings then on US stocks, bullish long-term, neutral short-term. On Canadian stocks, bullish long-term and bearish short-term. We haven't really managed to break the pessimism on the Canadian market in the short term. Gold neutral on both time frames. Oil bullish long-term and neutral short-term. Trading action relatively quiet in the last little while. Every day though, there's still a few strong moves, and if you're a day trader, you can really take advantage of those if you focus on the stocks that are highly liquid and trading abnormal volume. Now the long-term trends are up, but the confidence is kind of fragile as the market tries to hold support at the trend line. So be selective, or nothing wrong with sitting in cash. Gold is stabilizing, but it lacks the buyer enthusiasm. Oil should bounce off of the trend line and continue in its upward trend. All right, let's take a look at the day trade of the week, an example of a stock that we traded in the active live service that we offer at Stockscores. You can learn more about that at stockscores.com. Just go check it out. And here is a day trader strategy where we get an action candle, which is a abnormal 2-minute bar on the chart. It is abnormal volume, abnormal price movement that surprises the market. So we've got a stock here that nobody cares about. Then all of a sudden it comes alive. We have an algorithm that looks through the entire US stock market in real time. That's what Active Live is all about. And again, learn more about that at stockscores.com. There's the action candle early in the day on Friday, and it made a nice move to the upside after that. But let's look at the economics. This was a very odd trade. It did not take a lot of capital because the stock got so volatile very quickly. For $100 of risk, we would buy 80 shares, $742 of capital. We can margin that 3-to-1. So call it a mere $250 of capital to take $100 of risk. At the end of the day, it was up 4.5 times its risk, which meant a $450 gain, which on the capital that you had to put out for the trade was a 180% return. We don't see that too often, but it did happen with SGMA on Friday. Well, hope you've enjoyed this week's video. If so, click on the like button, leave a comment, tell your friends, tell your enemies, and most importantly, trade well.